So let us continue from where we stopped from. So in the previous video, we finished up by looking at the fundamental qualitative characteristics of useful information. So now let us continue by looking at the enhancing qualitative characteristics of useful information. So under here, we have basically three enhancing qualitative characteristics of, rather four qualitative enhancing qualitative characteristics of useful information. The first one is understandability. Rather, we should start with comparability. Okay, let's start with comparability. So the first one is comparability. So you want your financial statement to be able to be compared between two different entities and also between the same entity over years. So for you to achieve this, you need to apply the consistency theory. So you want to able for me to actually compare company A's financial statement and company B's financial statement. So that's comparability. For me to achieve this, I need to apply same principles, that is consistency. Comparability also can be between the same entity but different years. So you have 2019 and 2020. So you are able to compare financial statements of this year and last year, something like that. So that's to do with comparability. You are able to compare between different entities, and you are able to compare between same entity of different years. So for this to be achieved, you have to apply consistency. So the other thing is verifiability. Verifiability. So you want your financial statement to be able to be verified, right? To be verified. So financial information should be presented in such a way that an independent and reasonable user can be able to verify some figures and also relate to the narratives within. So you can be able to, an independent person can be able to verify. For example, you are saying that there's an income of 200,000 that month. So we should be able to verify. We can go in the day books and see that figure. We can go to source documents and see that figure, right? Because it is verifiable. So you are saying that you want your financial statement be capable of being verified by an independent person who is not connected to the company can be able to verify this. The other thing is timeliness. So you want your financial information to be presented on time for it to be capable of making a difference in the decision. You understand that we have a time frame from to which we want to make a decision. So if your financial statement come out later on when we cannot be able to make a decision, then the financial statement are not even relevant. So you want them to come before you can make your decision. Now, those financial statements will have good enhancing characteristics. And lastly, understandability. Right? You want your financial statement to be understandable, simple and clear, so that people can understand. But take note, understandability does not mean that you are supposed to actually dilute the financial statement because you feel like, for people to understand, that means I have to dilute it. And because of diluting it, you lose the meaning. This understandability should take in account that the one who's reading the financial statement should have some business and economic knowledge of that business. So the other stuff that are complex that you cannot simplify, financial instruments, they are one of the complex financial standard you're gonna come across with. So we don't have to simplify them. and end up losing the meaning. No, we'd rather keep the meaning and make them complex than dilute the meaning and actually make them simple to understand. So you have to strike a balance between making them simple and maintaining the real meaning. So that's that's something to do with the understandability. So those are the enhancing qualitative characteristics of financial statement. So let us go to the other heading in the conceptual framework. Remember, we are still looking at headings in the conceptual framework. Let us not lose track. We are looking at the headings in the conceptual framework. So let us go to definition, recognition, measurement of elements from which financial statements are constructed. So when we're talking about elements of financial statements, we are talking about assets, liabilities, equity. So let me just say elements of financial statements. So we know that we have profit or loss as a statement. In here we have income and expenses. And under statement of financial position, FP, S, we have assets, liabilities, and equity. Now that we have identified the elements of financial statement, let us now define these elements. So let us start with asset. What is an asset? So an asset has been defined as a resource controlled by an entity from past event from which future economic benefits are going to flow to the entity. So in the definition, we are saying that it needs to be a resource controlled by an entity. So we need to make sure that it is a resource controlled by an entity. So let us talk about resources controlled by an entity. So they are saying that it is a resource controlled by an entity, not resource owned by an entity. It needs to be controlled. If you have control of that over that resource, then that one is it's qualifying to be an asset. One, and it should arise from past event. So for that asset to come about, there's supposed to have been an event or transaction that has already occurred, right? For example, if I buy a car, if I bought a car last week, that means that's a past event, right? So the transaction doesn't have to happen in future, but it has already occurred. So the other thing is we're expecting future economic benefit to flow into the entity. So for an asset to arise, it needs first to be a resource controlled by an entity, not owned, not necessarily owned. You can actually just control it. No need for ownership for it to be qualified as an asset. All right. Other thing should arise from past event. And lastly, we should expect future economic benefit to flow into the entity. So with this, now it qualifies to be an asset. If it qualifies all the three, that is an asset. So let us look at a liability. A liability, on the other hand, is a present obligation of an entity arising from past event, and lastly, the settlement of which is expected to result in outflow from the entity resources embodying the economic benefit. So there are three things as well. For a liability to be a liability, there's supposed to be a present obligation. Right now, you are obliged. We're not talking about obligation. You're talking about you are required to do something. Right? You are required to do something. So right now you have a present obligation. Not that you have a present obligation in the future. No, but right now, as currently, you have an obligation. That's the first thing. The obligation should arise from an event that happened in the past. Arise from past event. So, for example, if I borrowed money last year, today I'll have a present obligation to repay back. So, because it is a present obligation and it is rising from a transaction that happened in the past. And lastly, when you are settling this obligation, you should expect an outflow of economic benefit. So you're expecting that economic benefit will flow out of the entity because you are settling this this obligation. I'll take money from the business and pay. So that's an outflow. So that's a liability. So let us look at equity. So equity is basically the residual interest in the assets of the entity after deducting or its liability. So we're saying whatever is remaining in the assets of the company after you have deducted or the liability. So you have your assets right here, right? You should deduct all your liability. That one is equal to equity, capital or equity. So we're saying is the residual interest in the assets of our company after deducting all the liability. You know the accounting equation. We say capital is equal to assets minus liability. So that's to do with equity or capital. So equity is the same as capital. So let us look at income. What is income? So income is increase in economic benefits during the accounting period in form of inflow or enhancement of asset or decrease of liability that result in equity other than those relating to equity participants. So we've been looking at economic benefit. So I haven't explained what economic benefit is. So we're saying economic benefit is what is some benefit that we are gonna receive from use of something. So we might receive money, right? That's an economic benefit. We might save money. From using that one, we might save money. It might help with some activities on an entity. So all those can be economic benefit. So we're saying that it is an increase in economic benefit. So you're saying that your economic benefit is increasing. So the economic benefit can be in form of inflow, something is coming in, or your asset is being enhanced, the value of your asset is going up, or if there's a decrease in a liability. So this increase in economic benefit is resulting into equity increasing as well. Your equity is also increasing because of what? This increase in economic benefit. But that increase should not be related to contribution by equity participant. That means if, for example, I sell my goods, money will come into the entity, right? Money will come into the entity, meaning that my equity will grow. That is an income. Have you seen? For example, if I revalue an asset, right? That one will also, the enhancing capacity of the asset will increase. So that one will also be an income, right? It will also increase your equity figure. So they are saying that, but should not include those that relate from equity participant. They are saying that if we are saying that an equity participant, we are talking about shareholders. So if shareholders have actually paid some money or injected money into the business, that's not income. Yeah, it has increased the equity because equity will increase, right? But that one won't be what? Income, because they have excluded any contribution from equity participants. So let us look at expenses. What is an expense? So an expense is a reduction in economic benefit. So it's direct opposite of income. It's a reduction of economic activity or economic benefit during an accounting period in form of outflow. So in form of something going out, one, depletion of an asset is being depleted in terms of depreciation, right? Or an increase in liability, where the liability is increasing, is also an expense that results in decrease in equity. So it will result in decrease in equity as well. So you're saying it is a decrease in economic benefits. This economic benefit can be in form of outflow, can be in form of depletion of assets, or increase in liability. Right. So this will also make the equity to go down. Equity will go down. So, but the definition has explicitly excluded any reduction that is being caused because of payment to equity participants. If the equity is reducing because we are paying to shareholders, yeah, that's maybe dividends, that one is not an expense. That means dividend is not an expense. Although it is reducing, it's reducing equity, that one is not an expense because it has been excluded from the definition. So, let us now look at the recognition of financial, recognition of element. When we are talking about recognition or recognizing an element, so recognition, we're actually saying that we are including it in the financial statement, including it in the financial statement. The financial statements. So that's what recognition. If we have included something in the financial statement, that means we have recognized it. So the definition is the process of including an item in the financial statement. That's recognition. So let us talk about the two criteria of recognizing elements in the financial statements. So we have two criteria of recognition of elements in the financial statement. The first thing is it is probable that there will be future flow of economic benefit to or from the firm. That's the thing. And the item has a cost or the value can be measured reliable. So these are the two major criteria of recognition. The first thing is it is probable that future economic benefit is either going to flow into the entity or flow out of an entity. And the other thing is you can actually give it a cost, or you can measure it reliably. So those are the criteria. So if we talk about liabilities, for example, assets and income, right? The criteria will be: one, we're expecting economic benefit to flow into the entity. That's the first thing. And we can measure it reliably, give it a value. Right? That's the first thing. The other thing is liabilities and expenses. So this one, we are expecting economic benefit to flow out of the entity. That's the first thing. And the other thing, it can be measured reliable. You can give it a value. You can give it a value. Is the expense 20,000, 50,000? If you can just say that it's an expense, you're trying to give it a value, then you cannot recognize it, because all elements in the financial statement need to have a value. So that's the recognition criteria of elements in the financial statement. So let us look at measurement of elements. We have talked about definition. We have talked about recognition. Now let us talk about measurement. When we're talking about measurement, it's determining the value to be included in the financial statement. What value can you give that element of financial statement? If you have a car, what value can you give it? If there's an income, what value can you give it? That's measurement. So the conceptual framework has talked about a couple of models, 4 models of measurement. So we have the historical cost model, we have the current cost, we have the realizable value or the settlement value, and we have the present value. So the thing is, what is the historical cost model? So when we're talking about the historical cost model, we're saying that an asset and liability will be recognized or measured at the amount that was paid for. So the amount that you have paid for, that's the historical model. For example, I bought a car 3 years ago for 3 million. It will appear in my financial statement as 3 million. The amount that I paid for, that's the historical cost. Right? Historical cost. So historical cost, the amount that I paid for. Right? So let us talk about the current cost. The current cost, we're saying the asset will be carried at an amount of cash and cash equivalent that would have to be paid if the same or equivalent asset was to be acquired. I bought the asset 3 years ago, but today, right, if I want to replace it, I want to buy another one, how much will I buy the same kind of asset? Maybe today I might buy the asset at 4 million. So you're saying that the amount for you to replace the asset today, currently, the same asset, how much can you replace it? So it can be 4 million. Historical can show that it's 3 million, the amount that you paid for. Currently today, this is bought 3 years ago. So currently today, if you're using the current cost, you are saying how much for you to replace the same asset. Maybe you can pay 4 million today, right? That's the current cost. Or this is the historical cost. While when we are talking about realizable value is the amount of cash that can be currently realized if the asset is sold. Today, the asset that you bought 3 years ago, how much can you sell it for? Maybe today you can sell it at 1 million. So the amount that you can realize or you can sell it for, that's the what? Realizable value or realizable cost. That's realizable cost. And the present value is the current estimate of value of future net cash flow. So you are saying that the asset, maybe you're expecting to use it for the next 2 years before it actually its useful life ends. So what you are saying is, how much can I benefit from the use of this asset? So the cash flow that you're expecting to benefit. For example, the car is a tractor, right? So you're expecting that in year 1, the remaining 2 years in the future, you're expecting that maybe in next year, maybe it will bring me cash flows of 500,000. The other year, the last year, it will give me cash flows of 400,000. So we will need to present this in present values. What? Maybe the present value will be 450. This one will be 300. So the value will appear at 750. So you're saying that the present value is the current estimate of value of future net cash flow. So you're saying, what am I expecting to receive from the use of this asset for the remaining useful life of the asset? So that's how I've differentiated the models. So we saw that the historical model is the amount that I paid for. The current model, the amount that I can pay for to replace the asset. Realizable amount is actually the amount that I can get for that asset if I sold it today. While the present value, you're actually estimating the cash flows in future, right? And that will be the value. So that's the present value. So let us look at capital and capital maintenance. So it's capital and capital maintenance. That's the last heading. That's the last heading we're supposed to look at. So we're now talking about capital and capital maintenance. So what is it all about? So a business should maintain the amount of capital invested and retain profit in the retained profit is measured by the value of which the capital is increased during the period. So what we are saying is, for a company to continue, you have to maintain your capital. For example, if you injected 500,000 in a business, you expect that the capital, what? Your capital should never go less than 500,000. That's capital maintenance. Because if you are going below 500,000, that means you are using up your capital. So that's capital maintenance. You are required to make sure that your capital is maintained 500,000 or more, right? The retained earnings will make the capital go up. That's to do with capital maintenance. So we have two models that we can measure capital maintenance. We have the financial maintenance and we have the operating or physical maintenance. So the financial, we're talking about capital is measured as the monetary value of capital at the beginning of the year against at the end of the year. So you are saying, how much do I have at the beginning of the year? I have 500,000 my capital. At the end of the year, I have 550, meaning I have been able to maintain, and it has also grown as well. So the difference is the one that will be the retained earnings for that year, the one that has made the asset to grow. So we have maintained our capital. That's to do with capital maintenance in terms of financial maintenance. When we're talking about physical operating maintenance, this is where capital is measured in terms of physical units of the core business. The aim of the measure is to ensure that the business is able to maintain its operating capacity in terms of high inflation. So, for example, if I had the capital of 500,000 and I was able to produce maybe 1,000 units of whatever I produce. For example, I produce sugar. So that means the cost for each sugar was 500 kwacha. That means I was able to produce 1,000 units, right? But at the end of the year, because costs have gone up, the cost for me to produce one packet of sugar is 1,000. So if I divide it by the capital I have right now, it shows that I only produce 550 units, meaning I have not maintained my capital, because at the beginning of the year, the capital that I have, I was able to produce 1,000 units. But because there's been inflation of the cost, right? The costs have gone up. Now I'm not able to maintain my my level of output. That means I have not maintained my capital in terms of physical output. But if the cost maybe just rose to, for example, maybe let's say 510, right? It has rose to 510. So let us see how much units can I produce with the capital I have. So I can produce 1,078. So I have still maintained in terms of physical unit, because I was produced 1,000 and I've maintained it, the 1,000, and also have also increased with 78 units more. So that's to do with capital maintenance. So for a company to continue, you need to be able to maintain your capital. Otherwise, you are going to close down if you're not able to maintain your capital. So those are the headings in the conceptual framework. So now let us look at the sources of GAP that we talked about in Malawi. So we talked about the Companies Act. Currently using the Companies Act 2013. So let us look at how the Companies Act will govern the preparation and presentation of financial statement. So the Companies Act will say how a company can be formed and the requirements for each form of business. Everyone who has done company law will know that company law will talk about the formation of a company. It will also talk about preparation of financial statement and the dates for filing financial statement. It will also talk about when you should file your financial statements. And they also talk about preparation of financial statement. They also talk about requirements of auditing financial statements, and it also also talk about the issue of corporate governance. So you can find this on page 19. I've never seen them being examined. That's why I've not focused a lot. But you should know that Companies Act is one of the sources of GAP. Another thing is the Malawi Stock Exchange. Firstly, before a company is listed, there are specific financial information which is supposed to produce to assist the potential investors in deciding whether to invest. We talk about stock exchange as a market for securities. So before you can be participate in the market, you are supposed to satisfy some financial reporting requirements. So it will talk about what you are supposed to produce. So any listed company is required to prepare and publish mid-year results as opposed to only producing financial statement at the end of the year in case of other forms of business. So for example, if you are to be part of the market called the Malawi Stock Exchange, you are required to produce 2 sets of financial statements. Mid-year, that means for example, in June, you're supposed to prepare your mid-year financial statement, and the year-end financial statements, which will incorporate the whole year. So this is required by all listed companies who are participating in the stock exchange, while all other companies are just required to present year-end financial statements. So we have seen how the stock exchange regulates the preparation and financial statement of listed companies. So let us look at the other source, which is the ICAM. So let us know the roles of our body. What are the roles of our body? So the first is to promote the development of accountants in Malawi. So they are there to develop accountants in Malawi. That's why they have their own body. They have their own exams so that they can produce their own accountants in Malawi. That's to do with ICAM. The other thing is to supervise accounting profession to the best interest of the public. So this guy also is going to supervise how accountants are handling themselves. So in the public interest, because us as an accountant, we act in public interest. So there's the watchdog, which is the ICAM, that is there to supervise our performance to ensure professional independence of accountants. So we need to be independent. So ICAM will ensure this to determine the eligibility criteria to become a member of the institute. So this the institute also set out the eligibility criteria. So for you to be a diplomat accountant, what are you supposed to? You need to hold a technician diploma certificate. You need to actually practice for at least 6 months and you have to apply. So those are the criteria. For you to be a chartered accountant, you need to qualify with any body, ACCA, ICAM, SEMA, and you have to practice for at least 3 years. So those are the eligibility criteria that has been set out by the ICAM. And to develop professional qualification for accountants and auditors in Malawi. So other roles, you can find them on page 20 of our manual. So let us look at MAB, and that will be the end of the chapter. So MAB, what is the role of Malawi Accountant Board, MAB? So the first thing is to promote high quality reporting of financial and non-financial information. So MAB is there to promote high reporting of financial and financial information. They want the financial reporting and non-financial reporting should be of high standard. They are the ones that will promote that. The other thing is to promote highest professional standards among auditors and accountants. So they will make sure that auditors and accountants adhere to the highest professional standards. The other thing is to protect the interest of the general public and investors. So we know that accountant, we are doing it in the interest of the general public, right? So the thing is, we don't want accountant to be stealing or doing them in their own interest. So the MAB is there to make sure that everything that we do as accountant is at the best interest of the general public. So to maintain the register of chartered accountants and diplomat accountant. So if you are a chartered accountant, if you are a diplomat accountant, your name will be stored by the Malawi Accountant Board. And lastly, to encourage effective collaboration with other regulators. So they'll make sure that they are able to collaborate with other regulators. So you can find other roles of MAB on page 22. So this is the end of chapter 1 of our manual. So we should look at the end of chapter questions and see if we are able to answer these questions. Thank you.